Hi, this is John Enright with Custom Wealth Management, and it's a gorgeous day in Syracuse, New York, as you can see. Not such a great day in the U.S. stock market. With the coronavirus originating in December of 2019, we actually currently stand at about 110,000 cases of coronavirus spread over 95 countries with nearly 4,000 deaths. In the United States, we stand at just over 500 cases being diagnosed, and we've identified 22 deaths. Currently, these numbers represent a fraction of 1% of the world's population and of the U.S. population, respectively. While we should all have some level of concern and be making considerable efforts to prevent the spread of this virus, it's also very important for us to keep our emotions in check. More about that in a moment. First, I'd like to provide a little more information on the coronavirus, also known as COVID-19. At the highest risk are older adults, persons with chronic medical conditions such as heart disease, diabetes, or lung disease. For anyone in these categories, it's obviously very important that you take extra precautions to reduce your risk. For those folks having an extra supply of things such as their prescription medications, facial tissues, aspirin, soap, hand sanitizer, etc., having those types of things on hand can certainly make sense. If the virus is in your area and spreading, be sure to explore options for grocery delivery and minimize your time spent in crowded or public areas. And of course, it goes without saying to be sure that you wash your hands frequently. Keep others informed of your health. Make sure you do that by email or by phone so you're not spreading the disease. And if you experience difficulty breathing, shortness of breath, persistent pain or pressure in your chest, or bluish lips or even face, be sure that also if you have increased confusion, be sure to seek medical attention immediately, by phone or in person if it's necessary. But please again make sure to take all measures to prevent further spread of this illness. The CDC has also provided significant information on their website following link, and you'll see that on your screen in a moment. But it's at cdc.gov/coronavirus/19. I encourage you to take some time to read the details from the CDC and to revisit this site for updated information. As a refresher, there's also a significant amount of misinformation on social media, the internet, and through other sources. So be sure to reference the CDC website frequently for proper and accurate information. The most important role that our team here at Custom Wealth Management can serve for you during this time is to consistently provide you with information and support to ensure that you stay on track with your overall finances. To whatever extent, we will most likely all have feelings of fear, feelings of anxiety, and or even of guilt. One of the realities of being human, we're not just well equipped for assessing risk. SciComm.net put it this way a couple of days ago. In quotes, it helps to look at coronavirus in the context of other illnesses to get some perspective. The coronavirus currently has a death rate of 2% worldwide, far below the 9% to 12% death rate that the 2002 SARS breakout had, though higher than the common flu in the U.S. Despite the information we do hear, part of the trouble is that humans are just not great at assessing risk. According to Paul Slovic, who's a PhD, who researches risk and decision making at the University of Oregon, how risk is conveyed determines ultimately how it's interpreted as well. And people use their emotions, not logical analysis, to evaluate risks. End quote. What I'd like to show you is this emotional cycle chart. And all of you have seen this before from me because it's a great piece that I've used since 1999 to help demonstrate the movements in the stock market or even in the economy and how our emotions tend to go. Recognize that where there is chaos, there is often financial opportunity. Warren Buffett is the master of separating emotions from finances. And the result has been clearly significant for him. This is a great piece that helps us to associate where we are in the stock market cycle and what emotions are tied to that moment. While I've been doing this every day of my life for the last 21 years, I've got to admit, I still experience these emotions. However, I also recognize that it's important for me to take control of those emotions and not to allow the way that I am feeling to influence my decision making. That is not to say that my head is in the sand, actually far from it. We are actively looking for opportunities in this market environment for you to take advantage of, as we see others allow their emotions to influence their decisions and, of course, their actions. I'd also like you to take a look at this average performance piece. Our goal is to help prevent you from being a part of the statistic you see here. For those who do allow their emotions to get the best of them, investing becomes a very difficult challenge. Unfortunately, many in our position as an advisor take the path of least resistance, and they simply sell off a client's portfolio because of their own emotions or because of the emotions of their client or the sense that they feel that their clients might be reacting. What you see here is the result for the average investor being far worse than that of major indexes over the last 20 years. This is a very powerful piece to understand. One of the greatest reasons for this is emotions. The obvious rule with investing is to buy low and, you know this, sell high. But one's emotions tends to lead them to do just the opposite. They sell when things are not good, when the markets are low, and they buy when things are better or when the markets are high, which is the polar opposite. That's clearly selling low and buying high, the opposite of what we want to do. And if we can't keep our emotions in check, that will obviously lead us to do exactly what most investors tend to do. Even worse, typically when one sells, it takes them time to get back into the market. You see, if you were fully invested over the last 20 years, by looking at this piece, you can see ending December 31st of 2018, and if you had your money in the S&P 500, your return would have averaged 5.62%. However, if you had missed just the best 10 days of that 20-year period, your return would have actually been cut by more than half to about 2.01%. And if you missed just the best 20 days, your return goes negative. Yes, missing the best 20 days out of 20 years led to a negative return over the entire time period. Some may think it's hard to miss those best days. Take a closer look at this piece though. Considering most that sell do so on the worst day or close to it, and they don't get right back into the market for some time, consider this fact. 6 of the best 10 days occurred within 2 weeks of the 10 worst days. The key is to put the current activity into the context of the bigger picture and to acknowledge that biases can certainly affect investor thinking. These factors may lead investors to believe that markets are doing worse or even better than impartial analysis would reveal. Couple of biases to consider. Confirmation bias. That means giving more weight to trends that you already believe in. Availability bias. That means giving more weight to recent events. And framing effect. Letting the presentation of information via the media affect your interpretation of it. So if you can control those biases and thereby control your emotions, it'll have a significant impact. And great news, you are not the average investor. You have a team that looks out to take advantage of opportunities like this. We are 100% committed to being available to you to discuss with you our approach by phone or in person through this entire process. Simply put, we're evaluating each position you own. We are determining if we should continue to own that position or if we should trade to another position that presents more value in this market. Here you see a piece that was created by J.P. Morgan that refers to the 7 principles for success in long-term investing. And I find these to be very helpful in times like this. These 7 principles have led to great success over the years. Let's get a little more specific. The approach we take to managing your money is important for you to understand, which is why we focus on that approach in every meeting that we have with you. While it is easy to pass that discussion or pass it over in our meetings, it's times like this that your understanding to that approach is extremely important. And that's why I want to make sure we take a few moments to talk about it now. Hopefully you recognize this visual. If not, we've not done a great job of explaining it to you, but more importantly, ask us about it specific to you. And what's important is that we work together with you to always protect your portfolio for your most immediate needs, while also managing your portfolio for the future. When you're within 2 years of retirement, which is the bottom part of this, we begin to shift some of your funds to cash, as well as shut off the automatic reinvestment of dividends, of interest, and of capital gains that are distributed from your portfolio. Between these three sources and the cash, we want to ensure that we have at least 1 to 2 years of your foreseeable withdrawal needs. And then if that's available in cash, we know we're not going to experience any volatility with it. With regards to the bond portion of your portfolio, as you can see, we use this for the next 2 to 7 years of withdrawal needs. Bonds tend to be more conservative than stocks and give us a short-term place to turn to for withdrawals, especially when markets are volatile like they are now. As a matter of fact, since February 17th of 2020, the U.S. aggregate bond index is up nearly 4%. Over that same time period, the S&P 500 is actually down about 13%. It's pretty neat to see how these different types of investments perform at different times, and it reflects how important it is that they are both included in your overall portfolio. Finally, for the monies that are invested for the longer term, defined as 7 years and longer, we allocate these to a diversified equity portfolio or stock portfolio. During good times, this is going to be the part of your portfolio that you're very happy with and that you wish you had more of. It just goes without saying, of course, the best part of your portfolio you always want more of at the given time. During bad times, this is also the part of the portfolio that you wish you didn't have, that you're most frustrated with, and that you wish you had less of. On the flip side, you wish you had more bonds. You can see that we take our work very seriously and that we'll consistently monitor and evaluate your portfolio and the positions that you own throughout this entire cycle. While we are not taking the coronavirus or COVID-19 lightly, we're also reminded of past outbreaks of viruses and diseases. Our friends at First Trust really did a nice job with the piece that you're looking at now, and they put together this piece to help demonstrate the occurrences dating back to 1980. While we have no idea how the coronavirus will ultimately reflect on this chart, we certainly know that it will be on it, but we're also reminded that these events do occur, and the stronger the effort that we all put into preventing the spread of this virus or any virus, the better off we will all be. I hope you found this piece valuable. I want to leave you with an invitation to call or email me with any questions you might have, with any clarifications you might desire on what we just discussed, if you are feeling your emotions taking charge, or if you simply just want to check in. Most important, I hope that you and your loved ones are safe and sound, and that you are able to remain free of the COVID-19 virus. Please be sure to refer to the CDC website that I mentioned earlier, and look at that website frequently for updates and details on how to best prevent and treat this virus. Our very best wishes to you, your family, your loved ones, and thank you for taking the time to watch our commentary today.